The U.S. debt has been downgraded again. And so many people have used this opportunity to say the empire is going to collapse again. And we have heard this several times. And part of the reason we have heard this several times is this isn't the first time this has happened. It's just another domino in the continual number of dominoes that are always supposed to lead to the collapse of the American empire. So is it different this time? Well, maybe it is. But what we're going to do today is walk through what has happened in the other times that this same thing has happened. And we're going to look and see how markets reacted when it did. And so I'm not going to sit here and tell you what's going to happen because I don't know what's going to happen. But what I am going to do is try to give you some context for what is happening and give you some information, real world information, not made up in a blog post information, and let you come to your own conclusion on what it means and what potentially is going to happen as a result. So I'm just going to pull up the screen and we're going to walk through a number of slides. And when I do this, I'll try to put my cursor on the right spot so that you guys can kind of see what I'm talking about. But like I said, on Friday, after the market closed on Friday, Moody's announced that they were cutting America's pristine credit rating, citing the rising debt. But let's be honest, this isn't the first time that the United States has seen rising debt. And in fact, I think Moody's just wanted to get in on the party because about 14 years ago, S&P did it. And then a couple of years ago, Fitch did it. And I think Moody's was probably just feeling a little left out and didn't want to be standing there all alone. So now they've done it. Now, one thing I want to make clear is I'm not saying this isn't important. I'm not saying that this isn't a big deal. It is something that's important. It is something that you should look at. It's just not necessarily something that you should see the headline and jump to a number of conclusions. So let's just jump forward here. Let's see. Okay, so I've also had a number of people, in the last, not even 24 hours yet, or I guess about 24 hours, send me emails, send me text messages, contact me on Twitter saying, see, this is the end. This is the end of the milkshake. Bonds are falling. Nobody trusts treasuries anymore. But again, let's step back and think about what did the milkshake actually say? And what is it all about? The milkshake is essentially all about a framework to understand how markets might react in the event of a sovereign debt crisis, and also what could cause that sovereign debt crisis. So the very first time I ever mentioned this, the first time I ever explained it in detail, I addressed this exact topic. And so the best thing I'm just going to read you some excerpts from the original interview because I think it's important for context here. And if anybody's interested in watching the original, I'll post the link in the description of this video. It was recorded 6 or 7 years ago on Real Vision. It's now available on YouTube. Anyway, you can look for it and listen to it yourself. And it's this part starts around the 16-minute mark. And essentially what I said is I think the milkshake is going to push equities to all-time highs. And I also think it's going to have a big impact on bonds. And I am of the opinion that interest rates are headed higher. I don't necessarily think bonds are going to crash, but I think they are going to break. And I think that is going to have a big impact on assets. And then I go on to a few other points, but then, I reiterate, I think rates are headed higher. When rates rise, bond prices fall. And then I said, when you think back to the fact that over the last 40-year bull market in bonds, that means somebody could have invested their whole life for 40 years and been a fixed income investor and made money quarter after quarter, year after year, decade after decade. They never really lost money on bonds as long as they were buy and hold. Sure, along the way, maybe they did some trading of bonds where they lost money, but essentially nobody lost money in bonds in 40 years. Well, now we have interest rates headed higher. And then I go on to say, when people actually start losing money in bonds, I think that's going to be a real wake-up call, not just for finance, but from an emotional perspective. If you have made money on something for 40 years in a row, and then all of a sudden you wake up and you've lost money, it's kind of like the turkey at Thanksgiving. They have 364 great days, but that 365th day is a kind of a nightmare. And I think this can happen in bonds. And as funds flow out of bonds, I think that's going to flow into equities. And then in other parts of the same interview, I say that funds will also flow into gold. And that was essentially why I thought bond prices would fall, interest rates would rise, the dollar would rise, equities would rise, and gold would rise. So the reason I point this out is I think there's a misunderstanding between being a treasury bull and being a US dollar bull. These are two different things. And these two things often trade opposite each other. Now, they don't always have to trade opposite each other. It's just that they historically often do. And if bonds have a huge rally, which I admit that they could, that will not be the milkshake being right. Because I've said interest rates will rise and bond prices will fall. But as part of this, I have also said, even though treasury prices will fall, I think bond prices around the world will likely fall. And even if bond prices around the world don't fall, the U.S. will be the last sovereign standing before it defaults. So anyway, now let's kind of walk through what's going on now today. So again, Moody's on Friday downgraded the United States. And this happened after the market closed. But referring back to this chart, at one point in there, I referred to the chart of truth. And the chart of truth is often referred to, at least in my kind of circle, as the 10-year Treasury yield. And again, it shows here for so many years, for 40 years, this yields were trending down and to the right. And they'd go up and they kind of bump the top of this channel every now and then, maybe even break out a little bit, but they always ended up back in this channel. But then in 2021, they finally broke out of this channel. And now they've been going higher. And that's kind of, part of the thesis is that these prices will, or the yields will stay above that trend line. So okay. So what happened on these previous occasions when the U.S. debt was downgraded? So if we go back to July, actually it was the first week of August of 2011, the U.S. debt was downgraded by Standard & Poor's. Now this is the 10-year yield, okay? This is where it was downgraded. Typically, when something gets downgraded, then that would lead to people selling that because they no longer want it. And if they were selling the bonds, then that would mean interest rates would be rising. But they didn't. This is where they downgraded them. And what happened? They fell. Interest rates fell. Treasury rates fell, which meant treasury bonds were rallying. Even though they got downgraded, treasury bonds rallied as interest rates fell, as the treasury yields fell over the next 6 months. Now, lest you think that I'm just cherry picking a 6-month time period and that it was really actually bad for US bonds or treasury bonds, let's zoom out. This again is where they were downgraded, August of 2011. It fell for a couple years and then it kind of went back above it for a while. But then, 10 years later, after this happened, interest rates were lower than when this, downgrade happened. So this wasn't just kind of, it was almost after the shock of it got over, it was kind of a non-event, at least in the fixed income world. Now, what happened in the dollar? Well, this is where it was downgraded. Now, initially, the dollar fell off. Now, why did the dollar fall off? Because yields were coming down. As yields come down, the dollar is not as, you don't get paid as much to sit in cash if yields have come down. So as yields come down, investors got paid more to sit in cash or sit somewhere else more than the dollar. And so the dollar initially fell, but then that only lasted a couple of weeks. And then over the next 6 months, it had a huge rally. The other thing I would point out on this chart is look at the level that we're at. So this is the DXY index. It was at 74. It's at 100 now. So over the last 15 years, the DXY index has risen 25%. So when people are all talking about the dollar's going to die, it's going to go away, there's nothing they can do to stop it, it's up 25% in 14 years, 15 years. And now I know you're saying, well, that's not in purchasing terms. That is true. And again, going back to the whole thesis, fiat currency loses value. That is the whole point of investing to begin with. But over the last 14, 15 years, the US dollar has rallied 25% versus its peers. It's actually more than 25%. It's more like 30%. It's 25 25 divided by 75 is more like 33% rather than 25%. So again, it's a huge move that the dollar has done, despite the U.S. debt getting downgraded. Okay, so what happened in equity markets when that happened? Well, that wasn't so good. So here's a bunch of risk assets in July, last week of July, or into the first part of August of 2011. Now, this is where the downgrade took place, and you can see markets, for the most part, sold off pretty hard over the next couple of months. They rebounded a little bit towards the end of the year, but August was kind of the high point, or late July, early August was kind of the high point for the year for a number of these indices. So again, it's not that this isn't important, but it's important to kind of understand what the ramifications historically have been. Okay, so let's move on. Okay, so now we fast forward 10 years, actually 12 years. Now it's August again of 2023. And Fitch decides they want to get in on the credit rating party, and they downgrade the United States. So what happened? Okay. Well, this time, interest rates actually rose. So this time they downgraded here. Initially, yields jumped a little bit, and then over the next week, they kind of fell. They rallied. Rates rallied. In other words, bonds fell for about a month or two. And then by the end of the year, that was basically right where it was when the downgrade happened. So again, not some wholesale, disastrous boycott of buying treasuries as a result of yields or as a result of the downgrade. Now here we are, we zoom out again. Now, this is where it was downgraded. They went up, they came back down, and now since they've gone back up. Or sorry, this is the dollar. I apologize. Let me just make sure I'm looking at the right thing here. Oh yeah, the reason I didn't do a long-term chart of this is because this is only a couple of years ago. Okay, so a year later, or by the end of the year, yields were essentially where they were when the downgrade happened. So what happened to the dollar over that time? Well, that time, remember when I said yields rose? Well, when yields rise, then the dollar is more attractive because you get paid more to just sit in dollars. And so the dollar rallied. And then into the end of the year, remember when I said yields came back down? The dollar came back down. And then it's rallied since, And so again, the dollar is a little bit lower than this right now. It's a little over 100. So it's down a little bit, if you add another year on the start. But the point is if you were to look at this point, the dollar is basically right where it was in this area. It's gone sideways, despite the U.S. debt getting downgraded by Fitch. Okay, but what happened to risk assets last time? Again, not saying this isn't important, but it's just important to understand what actually happened the last couple times that debt was downgraded. And again, we saw at the end of July, beginning of August, that was kind of the high point for many indices, and they sold off, not as hard, not as dramatically, but they sold off again, from August kind of into late fall, and then they rallied a little bit towards the end of the year. So let me back up. So that's kind of where we're at now. Now, I don't know what's going to happen tomorrow or on Monday. It's going to be pretty interesting. We have a pretty interesting environment. And I know for a fact, some people out there are saying, yeah, even though this is what happened the last several times, it's going to be different this time. Well, you know what? Maybe it will be different this time. But what I know isn't different this time is that people aren't saying anything different this time. Because in 2011, they said it's different this time, and it wasn't. And in 2023, they said it's different this time, and it wasn't. So maybe this time it will be different. But I lived through both of those previous times and was doing this job during those previous times. And like I said, I don't know for sure what's going to happen when we come in on Monday morning. But it's all the common refrain is always it's different this time. Yes, the U.S. didn't have so much debt then. Yes, the U.S. didn't have so many enemies then. Yes, the U.S. didn't have running such a big budget deficit then. But you know what? They were running trade deficits then. They were running budget deficits then. They did have people upset with them then. They were involved in military operations overseas then. And so many of the reasons given for the reason it would be different those last two times, even though it wasn't, is many of the same reasons they're giving now. Now, admittedly, they're more extreme this time, right? But again, they were more extreme in 2023 than they were in 2011. And in 2011, they were more extreme than they were in the year 2000. So it always gets more extreme. And one of these times, it will probably be the last time. So again, I just want to reiterate, I'm not saying this isn't important. I'm not saying you shouldn't watch it, but it's important to understand what's actually historically happened. And the other thing is if U.S. rates continue to rise, which I won't be surprised at all, and it's actually my base case, that will lead to funding concerns for the rest of the world because the rest of the world also gets funding in US dollars. And the rest of the world holds US treasuries on their balance sheets, central banks, commercial banks, all over the world. So if treasury prices collapse, that's not good for the rest of the world. Now, is it good for the United States? No, it's absolutely not good for the United States, but it's not a bad thing for the US in isolation. So it's important to remember that. So that's what I kind of wanted to go over today. What I'm going to do now is we're going to run through a bunch of markets, and we're going to go through fairly quickly because I've kind of covered these last week, and then a few weeks prior to that, I covered them again. But the reason I want to show them to you is because it's pretty incredible when you see the similarity across all the assets. In other words, everything is correlated, everything is trading the same, and we are back to kind of extreme, not extreme. We're back to very concerning levels on some statistics that I have used historically to help me manage drawdowns. And so I'm just going to go over those again now. So if we look at the Dow, okay, so the first thing I want you to look at is last July. Last July, we had this peak. And if we look at the relative strength, you can see it was way overbought. And if you look at the stochastics, they were like at 99. And what happened? A hard drawdown in August. And then we had a rally, right? And then we got into late January. We weren't quite as overbought, but we're getting, this red line is kind of overbought. The green line is oversold. We weren't nearly as high as we were last July, but things were getting pretty frothy again. Stochastics couldn't really get any higher, and we rolled over pretty hard into April. And everything got really oversold in April. We've talked about that. We went through these exact charts and showed how these got oversold, about a month ago. And relative strength got oversold. Stochastics got really low. And so we knew we would get a bounce. We didn't know how far and how long, but now we've had the bounce. And we're not back to overbought territory in the Dow yet, but stochastics can't really get any higher. And what's interesting to me here is we've got the 100-day moving average crossing over the 200-day moving average, which is oftentimes seen as a bearish signal. Now, they're actually kind of perfectly even right now, but unless the Dow really jumps higher, those are going to cross. So to me, that's kind of interesting. And it's more interesting when I take it in conjunction with all these other charts. So here's the S&P 500. And by the way, I'm using the ETF, but this is the market that it covers. Again, if we look at that same thing, the 100 days getting ready to cross over the 200-day, we've had this massive rally. If we look back in July, we saw the same things. Very overbought, stochastics at the highs, roll over. We go back into January and February, markets at its high. We didn't get back to overbought territory, but stochastics got very high, and then we had the roll down. Got very oversold. This is why we were expecting a bounce in conjunction with the put-call ratio and in conjunction with sentiment. Again, we didn't know how far and how quickly it would bounce, but it's bounced almost all the way back up to the highs. And like I said, we've got those two lines crossing. We're basically at getting to overbought territory. Sentiment, I'm going to go over in a minute, is very high. And again, stochastics can't just get much higher than this. So it does this, let's be clear. This stuff doesn't mean there's going to be a crash. You don't have to sell here. You don't have to go short. You don't have to buy hedges. The point is if you are going to sell, or if you are going to hedge, or if you are looking to short, we're getting pretty close, if we're not there already, to a good opportunity to do that. And we'll go over some other indicators in a minute that'll help explain why. So if we continue going down across markets, now we've got the NASDAQ. Now we are in overbought territory. It's actually broken through. Again, stochastics can't really get any higher. These are the same things that we used to, get short last July, same things that helped us get short early this year. And so we've completely reversed where we were a month ago. Completely. It's even though I'm not shocked by it, it's still always amazing to kind of see it, especially, and this is largely due to a rise of passive investments. It's really hard to turn the ship, but when it does, and when flows stop coming in, and when people become buyers, you get these dramatic sell-offs. But then if the flows come back and there's no more decisions being made by people, and it's just buy, 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 you get this rocket back to the high. Okay, so let's look at the Russell 2000. Same story. We're not quite back to overbought territory on the relative strength, but stochastics are very high, and it's had a huge rally. This is where we start to get interesting. The tech sector has really, really rebounded hard, and it was the most oversold, and so that makes sense. But again, if we look back to July, this is Microsoft, right? You can see it was overbought, stochastics were really high, and what followed was a drawdown. Got back into January. Microsoft never really got really overbought. It didn't rally as much coming out of last summer's lows as some of the other tech names. But then when it got overbought in late January, then it rolled over. And now we're back to being just as overbought now as we were back here. And this chart, I mean, this has gone straight up. It's up, 35% or something in a month. And look, I mean, stochastics are at 99. You can't get any higher, right? So again, it doesn't mean there's going to be a crash, and it doesn't mean you have to sell, but this is not the time you want to be entering a market, right? And if you are looking to hedge, if you are looking to short, these, at least on this chart, it looks like a good opportunity to do so. Now let's look at the semiconductors. Kind of the same thing. We're back to overbought territory. Not quite as overbought as we were last summer, but similar. And if we look at the stochastics, can't really go any higher. Huge run up, probably due for a pause and probably a pullback. Now, if we look at NVIDIA specifically, again, we're not quite as overbought as we were last July, but again, we're in overbought territory. 99 in stochastics. We've just come a long way very quickly. Let's look at Disney. Disney is very overbought. And look, this actually, Disney was kind of struggling a little bit last summer. It would never really got as high as the others. It sold off into the late summer, rallied really hard into the year, got very overbought late in the year, kind of went sold off and then went sideways into March and then had the hard sell down. Got very oversold. Got very oversold a month ago, and then it's just, that's basically an exponential chart. I mean, it's just gone straight up. It's almost back to its highs. And again, stochastics are back at 99. If we look at, now here's where I think it gets interesting too, because so far we've just looked at U.S. markets. But if you look at global markets, they've all done the same thing. And not only have they rallied, they're back at all-time highs. And if we have some more downside, either due to Trump tariffs or geopolitical concerns or lack of liquidity, whatever it is, the rest of the world is going to be affected as well. And so when all of these have bounced as hard and as fast as they have, and now they're in overbought territory, again, overbought, 99 in stochastics, and you've got the green line crossing the yellow line, right? So that's Canada. If we look at the Nikkei, not quite as overbought, but the stochastics are very high. And we've got, this has actually crossed back here a couple of months ago. Nikkei isn't quite as severe as some of these other markets I'll show you, but here's Hong Kong. Again, we've got the green line crossing the yellow line. We've got it overbought, and we've got stochastics at 99. Again, you don't have to sell it, but don't be buying here. And then if we look at the put-call ratio, right? We look at the put-call, and you know what I should have put on here and I didn't. If you look at Spain and Italy and UK and Korea, they're all showing the same thing. So it's basically, as you can see, as I've walked through all these charts, they're all trading in unison. They're all saying the same thing. And they're all saying short term, we need a breather. Whether that turns into a sell-off, we'll have to wait and see. But all of this stuff is saying, hey, guys, let's just hold on a minute, right? Let's just be calm about this. Okay, but then here's another thing. If you add that in with the put-call ratio, last week, it was as low as it's been in over a year, which means nobody's buying puts. Everybody's buying calls, or at least nobody's buying puts, right? if you go back a month and we were at the highest, this is when everybody's buying puts, right? This is when everybody's hedging. This is when, I put up that tweet of, those people that are buying puts with the VIX above 50 are about to die. Well, they've gotten slaughtered. But now we've got the exact opposite again. And in fact, a week ago, or even just a couple of days ago, we had the lowest level of put buying, or the put call ratio in over a year. And then when you combine that with sentiment, now you can't see this very well, but the sentiment here that I'm going to focus on is the S&P index, the NASDAQ index, and the VIX. And the reason I point on this is it basically just shows sentiment, and it measures it from 0 to 100. You guys have heard me talk about this before. Anything below 20 is concerning. Anything below 10 is, that's when my model says I have to act, regardless of whether I feel like it or not, because that's extreme territory. And then on the upside, anything over 80 is concerning, and anything over 90 is extreme, and you act regardless. And so we didn't quite get to 80, but it's very close. I mean, it's essentially 80. So both the S&P and the NASDAQ are at 79, and the VIX is below 20. The reason I think this is important is we're coming out of an extremely oversold environment, and an environment where everybody was risk off. But the fact that, and even though we're not yet at total extremes, this is very high sentiment considering where we were just a month ago. And I'm not sure that in this environment we would ever, you have to understand, getting to 90, getting to those extremes, it doesn't happen that often. It's actually extremely rare. So the fact that we're even back to 80, which is concerning so quickly, is just telling me, we've come too far too quickly. And then the VIX is just the opposite. The VIX is below 20, right? And again, let's step back. Like, what has really changed in the last month? What's changed is the fact that rather than temperatures ratcheting up, they've ratcheted down. But we haven't signed any trade deals yet. Nothing has been put into stone. All we've basically had is a détente and a short-term ceasefire. And I would argue that both sides are using that ceasefire to reload. They're not using it to draw up peace plans. But we obviously got way too oversold a month ago. We didn't have any clarity. Everything was heading in one direction. And when things get that extreme to the downside, you knew there was going to be a bounce. But now we've come all the other way. Nobody's concerned. Everybody's talking about new highs again. And, VIX is low. Put buying is non-existent. And so now you can buy insurance a heck of a lot cheaper than you could, just a month ago. And so if a month ago, when the markets were down and you were kicking yourself because you didn't take a little bit off the table or you didn't buy a little bit of protection, well, you know what? Now you have your opportunity again. Now, I don't know whether it's appropriate for you to do it or not. You guys have to make up your own decision on that. I just know that when I look at this, and for my, process, we're back to the point where we certainly wouldn't be buying. And we have actually been, in the last week, been aggressively buying downside exposure, mostly to international markets, some of those international markets that I showed you, but also kind of selectively in U.S. markets here too. So, and this, you've heard me say this before, I expect this year to be similar to 2022. That's still my base case. And, we've had a 20% rally. In 2022, we had a 17% rally. So it's not totally out of pocket to have this rally. And not only that, but now we get into the May, right? And you go into the summer sold doldrums, and, maybe sell in May and go away is not a horrible idea this time. At least that's what my indicators are telling me. And then finally, let's just look at the VIX. I mean, the VIX is back below 20. It's at 17. Look at the stochastics on the VIX. It's below 1. Now, again, it doesn't mean that the VIX is going to 50 tomorrow. Maybe it will. I mean, Monday morning could be pretty interesting, actually. But it just means that, we had the ratchet up to 50 a month ago, and now we're all the way back down to where nobody's concerned again. And if you were kicking yourself a couple weeks ago that you hadn't lined up a bit, the market gods have kind of given you an opportunity that maybe you want to think about doing that. And this shows the equity market in the U.S. Friday after hours. So when the announcement came out, market sold off pretty heavy. You can see that kind of here. And then when the after hours close, and everything just kind of reverts to the closing of the regular. But it's going to be interesting to see when we come in Monday whether we have a down day reacting as a follow on to this, or if it's all been smoothed over by then. And the last thing I'm going to say is, if this year has been driving you crazy and you're pulling your hair out and you're not enjoying this, you should probably either not be doing a job that's related to this, or you should be having somebody else manage your money. Because this is as fun as it gets. This is honestly, this is like the macro Super Bowl. I have a hard time figuring out how we could ever have a more interesting set of circumstances than what we have going on now. It's scary, it's frustrating, it's nerve-wracking at times, but it's really fun and it's really interesting. And I guess what I'd say is, if this is not an environment that you feel comfortable operating in, then you should find somebody that can help you with it, because this is not the game for little boys and girls. This is the big boys. This is the big boys game. So, and it's anyway, I love it, and I consider myself extremely lucky that I get to operate in this. And I hope, maybe doing these and showing you kind of the things I look at and the things I think about, it kind of help you navigate this process a little better. Again, I can't tell you what to do. I don't know your personal situation. I can't give you advice over the internet when I don't know who you are, but I can point you out some of the things that I've learned over 25 years. And you don't have to make it super complicated. None of the things that I've showed you today, require a PhD in economics or financial theory to understand. All of these indicators are very simple, and all on their own, they're really not that important. But when you put them all together and you start to build this mosaic, you can certainly avoid many of the pitfalls that many investors fall into a trap of. So anyway, that's it for this week. Hope you guys have a good weekend, and we'll be back next week to do another one. All right, guys. Bye-bye.